Hello, everyone, and welcome to tonight's session of TradeFinder Live. My name is Zach. I'm from support at Elliott Wave Options, and I'll be facilitating this session with our guest speaker, Rob Roy, this evening. I'll introduce Rob here in just a few moments, but in the meantime, we do need to cover off a few important details about the session. All right, so first and foremost, this is our live disclosure disclaimer agreement. If you've seen any of our prior sessions, maybe it's a TradeFinder session or an insiders meeting, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Feel free to take a screenshot. It is on our website as well, but that's the main gist to take away. All right, so secondly, we do have a couple methods for asking questions. For this session on TradeFinder, it is brief at the end. There's only time for a few questions as Rob goes through his market analysis in the beginning and then opens it up for a few questions from Zoom and YouTube at the very end. So as you can see, the Q&A is circled there. Feel free to write your question at any point throughout the presentation, and Rob will hopefully be able to get to it towards the end. If not, just know it has nothing to do with the validity of your question. We just only have so much time allocated to this session. With that, feel encouraged to attend an insiders meeting where there's much more of a focal point on answering questions at the end of the session, or at the other half of the session, rather. Lastly, you see the chat window there. That's all for support related queries. So anything that support or panelists can help you with, please feel free to write that in, as well as interacting with other attendees on the chat. Just know Rob can't view any questions from the chat window, so be sure to write those into the Q&A window. All right, I think that about covers all the important details. And without further ado, I'll introduce Rob Roy.
Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to this week's TradeFinder. Thanks for the introduction, Zach. And as you take a look at the screen, you can see that if this is your first time in TradeFinder, welcome. And for those of you that have been here numerous times, welcome to you as well. Obviously, the way TradeFinder works is we'll go through, we'll talk about the markets. It says U.S. market update, but we've added to that. We've covered off a lot of the different markets. We've added the Canadian market that was popular. I did that on the last SPY update over the weekend. So special welcome to all of you that are streaming on one of the social media outlets. If you're on YouTube, please go over to our channel on YouTube. You can look at that last SPY update that I did over the weekend, and you can see talk about Canada. We're going to update that because some important things to talk to you about if you're interested in trading the Canadian market. And for those of you that are only interested in trading the US market, when I go through the international markets, please don't just tune out, because some of the markets are able to trade. We look at securities that are tradable on the US exchange. So if we find a good pattern that's another country's market, if you can trade it on the US exchange, it's worthwhile to take a look at, and might consider placing a trade in your own account. We'll go through and take a look at any closed alerts that we've done for our alert subscribers at Elliott Wave Options, give you an idea of how that works. Then we'll look at any sort of back trade ideas that we've identified in past TradeFinders. We have a few of them left. If you've been watching TradeFinder over the months that we've been doing this, you see that we've had a lot of really good trade ideas come out of TradeFinder. So we'll see if we can duplicate that this evening. And then, as Zach said, at the end, with whatever time's left, we'll open it up to a general Q&A. We'll get to as many questions as we can. Often that amounts to you guys giving us one of your favorite stock symbols, and we see what our technical indicators may have to say about that. So that's it. That's how TradeFinder works. Now, before we get to the charts, we do have a special guest this evening. Ken Farber, I've known for a long time. We've talked about how long we've known each other, which is far longer than I care to mention, because it just means that a lot of time has gone by. But Ken is part of the Elliott Wave Options staff. He runs our Option Accelerator class, which is far more than just an options basic class. It goes into other details, so I don't want to steal any of Ken's thunder. So Ken, if you're there, you want to pop in and let everybody know what you've covered so far in Option Accelerator and what they can expect to see this week and in future weeks. And welcome.
Thanks, Rob, and thanks for making the space for me. It's I always enjoy seeing your face. We're in different parts of the country, so it's just great to have this connection again. Yeah, the Options Accelerator classes, in introducing the class last week, one of the things I stressed is there's a ton of information. There's a ton of options training out there on YouTube, on different websites. But the difference is this is Options Accelerator Live. So we make it very interactive. And this is for our subscribers. And it's a means to go through the basics. And like you and I have discussed this many a time, for as many times as we've taught, quote, the basics, there's never a time I haven't learned something, from the questions, from the interaction. It's just the more we can strengthen our foundation and understanding, the more things we're able to see, and as we gain in our prowess as traders. So it's for the beginners and the experienced alike. The next session is tomorrow evening. We'll be looking at delta, gamma, and the relationship between the two. You know me, I'm looking forward to when we get to implied volatility as we start going through the Greeks in the next couple of weeks. So I don't want to take time from everything you're going to do with our good guests, but I just want to make an open invitation as to one more thing. It's just, as I was talking with Rob and the crew at EWO, we were talking about adding these classes. They were saying it's like, oh no, there's no additional charge for them. This is just additional service for our subscribers. So this is not, another add-on. I have to pay another nickel. This runs very different from anything I've ever been engaged with as far as options trading and instruction. And it's one thing I truly appreciate. So it's one of the things I enjoy about working with Rob is just your integrity. So my thanks to you, and I'm very pleased to be involved.
Thanks, Ken. I right back at you on the integrity, and it's great working together again as we did for so many years out on the road. Everything's done by webinar now. We don't do the live events. I'm sure you miss them as I do. And we're super excited about the material you're coming up. Obviously, delta and gamma it ties right into the strangles that we do, and you're so good on implied volatility. And man, I'm sure you got a lot to tell them as far as what's going on with volatility in the markets lately. So what a great time for people to become a subscriber and take advantage of your courses if they haven't already. No better time than the present with the subject matter that you got coming up. So appreciate you taking some time out to visit with everybody and give them a little bit of an idea of what they can expect. So thanks. Always good hearing your voice, Ken.
My pleasure, sir.
All right. Thanks a lot. And as Ken mentioned, I should have mentioned this in the beginning. I am back in, I call it the Dragon Capsule, because if you saw the office, it's surrounded by screens, etc. Did finally make it out of the mountains. It's been interesting on the trips how many times weather has kept me there. When you're on the top of a mountain, it's a little bit different scenario as far as trying to get out. It's not just hop in the car and go. You're kind of at the whim of what Mother Nature has in mind, but it's always good to be back here. So let's go ahead and take a look at the SPY. You can see there's a vertical move, and man, there's been a lot of questions on whether or not the bottom is in, right? Was the bottom in at 420? So let's go through and talk a little bit about that. As you can see from the move to the upside, and I've got a few comments to make about that, the zigzag pattern, that's the primary zigzag pattern, still has not been affected. What has been affected is the zigzag pattern that was within the C wave, creating a complex C wave, but the primary one, until we break above that 460 level, is still intact. Now, the other zigzag pattern started where that B is, came down here and moved up here. Now, that's been disqualified on this move, and I'll go ahead and show you that real quickly. And you'll be able to see that that's an 84% corrective move. And whether or not you buy into Elliott's view that once you hit 70%, it's likely that that's going to be the end of the zigzag pattern, or you stay hard and fast to the rules that the B correction hitting 78.6, that fib level, that becomes the point of disqualification. Either way, that zigzag within the C wave has been disqualified, but the large one is still in place. And so you have to pay attention to that. I talked about this last week. Some people were saying, you ought to put that on a shirt. Don't diss the zigzag. There's been quite a few times when it looked like maybe a zigzag was going to become disqualified, and lo and behold, it turns out and plays out. Will it happen this time? Well, we'll wait and see. But one of the scenarios is with that complex C wave has been disqualified. And what I wanted to show you, a couple things. One, you know what I'm going to say if you've watched any of these videos before, the vertical nature of this move to the upside. yesterday was a point, and I sent a note out to our subscribers that if we were going to reverse, then with that nice doji that we had yesterday on lower volume, as you can see, the volume has started to come in a little bit. The further the market's gone to the upside, the lower the volume has gone, but it didn't. We moved back to the upside once again today. So we did move to the upside, but the first time we've been below average on volume in a while. So when we're taking a look at this, does that mean that that's it? The bottom is in. Often new impulse patterns are started by short covering, and they don't have to have strong volume. So what I'm here is that we have to respect the fact that at this 61.8% fib extension, which is where we are at 420, there is the possibility that that was it. That's the end of the downward move. But with that big zigzag still in place, and the fact that this move was vertical, and we look at the 10-day moving average, you can see the vertical nature just by looking at the 10-day moving average. But then when you look at that, you can see we're overbought. We're pretty significantly overbought. Now, we've been overbought for a couple days, but it continues to move and on lower volume. So this is one of those times where potentially we're in between impulse patterns, and we haven't been super active on the alert situation with our subscribers, but we have been doing things, and we've been putting on upside trades, which I'll show you. It's not like we're just sitting there waiting on the zigzag. Is it going to become disqualified and we're not doing anything? But we have backed off a bit until the market tells us which of these LA wave patterns is going to be the one that's currently in play. Right now, both of them are. So when that situation occurs, it's best just to pick the cream of the crop, if you will, and wait until you get some answers. So with this vertical move to the upside, volume starting to move out, at least we could get a corrective move here. And that's also classic for starting an impulse pattern. If you know, wave one, by the rules, starts with short covering. And obviously, some of this vertical move to the upside has been short covering. And then you get the wave two correction. So is this a wave one? Is it an A wave of a zigzag pattern? Either way, we're due for some sort of a pullback, a corrective move here. And on top of that, I would submit to you that we're now at a point of resistance. So the doji yesterday didn't do it, but we're at resistance now. Can we go higher than 450 here? I'd be very surprised if we move above 450 without at least some backing and filling and allowing the 10-day moving average to catch up to that. So I think even with the strength of this move right now, if you haven't been long on anything, would be a difficult time to put a long position on until you see how this correction plays out. Does the market come back down towards the 10-day moving average? Does it come down and satisfy the C wave? Or do we just consolidate here under 450? Now, that would be the strongest argument for the fact that the bottom's in and we're ready to move to the upside. If we just simply go through, consolidate, maybe some slight backing and filling here, letting the 10-day moving average catch up, and then try to make a run at breaking this resistance area at 450. So that's the next primary area from 420. The next primary area of resistance is 450, and that's where we are. So we had a little bit at 430 just from right here, not quite as strong, and the market went right through that like that was nothing. Is it going to do that at 450? I'd be very surprised considering the fact that we are stretched a bit to the upside here. And so to break above more resistance without having an opportunity to gather a little bit more energy, that would just surprise me significantly. So the next couple of days, you hear me say this all the time, right? The next couple of days are going to be very interesting in the markets, fascinating even, which is a word I apparently use a lot because I get reminded of that often. So we'll see how it plays out, but wanted to share those points with you. One, we are overbought. We're at resistance. Volume has been slowing just a bit. Still not horrible, but again, slowing down just a little bit. So we'll see what the market has in store over the next couple of trading days. And that's going to go a long way to answer whether or not we are in a new impulse pattern to the upside, or this was just simply a bounce. Volatility had been high. And that scenario that I talked about is still in play. If you're new, if you're watching for the first time, again, welcome to you, especially if you are one of the live streaming services. The fact that we get this rip your face off rally, and I think we can all agree that this move has been pretty much a rip your face off rally to the upside, sucks everybody in, convinced that 420 was the bottom. And then we turn around and we go down and make a new low. We break 420. Everybody throws in their hands. They bought the dip. And then we turn around and go lower again. And that just really gives you a flush out kind of a volatility spike. We've had high volatility, but we haven't had one of those big, huge vertical spikes yet. We don't have to have one, but it does happen often, or I wouldn't bring it up. And we really just everybody's like, I've had enough and I'm not going long ever again. That's when the bottom really is set and you turn and move back to the upside. Either one of those scenarios are very viable right now. So when you have two completely different scenarios that are extremely viable, the most prudent thing to do is be a little cautious. There's plenty of time. If the bottom is in and we are going to break this 450 level, we're going to violate that V wave correction. There's plenty of time to put on bullish trades, far more than what we've done already, and then continue to move higher from there. So pretty interesting with where we are right now. I was really excited about tonight's TradeFinder. Very excited to have Ken with us, and then also to go through and talk about the uniqueness of where we are right now. Having a doji on top of the 50-day moving average, market didn't even blink, just opened higher and continued higher throughout the day. So looking at some of the other markets now, I'm going to go ahead and show you the Canadian market first. Talked about this in the SPY update. So I think this is really important if you're interested in trading the Canadian market. And you can see it's the ETF that we're looking at, the EWC, which you can trade on the US exchange. We had this area here. And when we ran up against that over the weekend, we were right there. And then here's Monday and Tuesday. So we were right there. And if I were to walk this chart back to where we were over the weekend, you can see, again, we were overbought. And my comment was, if you're long the Canadian market, what you would like to see is some consolidation right here underneath this resistance from back in October and November. Let that 10-day moving average catch up, gather some new energy, gather some momentum, and then break the high and move to the upside. Well, the market didn't do that. The market just broke to the upside. And again, we are still overbought. Now, if you're long the Canadian market, I'll say that's not the most ideal scenario. And the reason I say that is because when you break a resistance level, but the market is already stretched, those are the type of breaks that may not hold. So we could possibly come back down, break below that level, just under 40, get back towards the 10-day moving average, or at least come down and test 40. That would be the most bullish scenario here, because again, it's hard to fathom going much higher from where we are right now without some sort of backing and filling. So the best case scenario, in my opinion, for moving higher and breaking the resistance didn't occur. So you trade what the charts are telling you, but it's really difficult, again, to go long the Canadian market today until we see this overbought scenario get corrected. And how it corrects is going to determine a lot on how you would trade the Canadian market. In other words, if we break back below that level of resistance, then you reset and you look for a break. Now, on the positive side, we broke that resistance level with a follow-through day. And if you've heard any of my recordings, again, you hear me harp this time after time after time, that when you break a major point of resistance, break out of a major moving average, triangle, et cetera, you have to have a follow-through or confirmation day. Well, we had that, but to me, it creates caution, throws out a bunch of yellow flags, if you will, with the fact that we were overbought and then broke it. So if we take a look at volume here, you can see that, well, today's move was on higher volume than yesterday. That's exactly what you want on a follow-through day. So this is a point where, yeah, man, you could get sucked into this, but could the market run up to that wave 5 target, staying vertical? It could. Anything is possible. Nothing is 100%. When I start talking about these things, these are just things I've seen from experience over training for a very long time. And but the market's going to do what the market's going to do, but it doesn't mean that we don't have to be cautious along the way. As I said, there's plenty of opportunities when things are more in line with what happens the majority of the time, rather than trying to trade on what happens a small percentage of the time. And the smaller percentage would be that we continue to go in this vertical move up towards that 41.5, 42 level. But we'll see how it plays out. I mean, I could be completely wrong. It's happened before and it'll happen again. It's one thing I can promise. All right, so looking at the Dow, and you can see that right up to the 61.8% level. We talked about this in the recording as well, with the bounce up here, that we could move higher. We were at this move right here on the 3rd of March was the 38.2% fib level. And I said that may act as resistance. Not really. We kind of blew right through that. And you can see that not only did we have that wave 4 right in that 38.2% level, but there was pretty good resistance from going back to September, October, November, January, and we went right through it. Like none of it was even there. Pretty surprising to me. But now we're at the strongest fib level, in my opinion, the 61.8% level. Can we continue to blow through that with being a little bit overbought on the Dow as well? Again, the market's going to do what the market's going to do, but that would surprise me. And so I would be cautious on going long the Dow today as well. Let's see what happens if we get up to that 70+% level, take out this high from back here, which is the zigzag pattern within the diamonds. And remember now, the Dow came extremely close to fulfilling the 100% extension. This low here on the 24th of February, the 100% extension was at 320 and the low was 322. It got awfully close. And as I've mentioned in the past, people say, well, that was awfully close, so that counts. And I just feel like these fib levels normally get touched. So could you say, well, it's only 2 points on the DIA? And yeah, it's only 2 points, but usually those 2 points get touched. Nothing's 100%, as we said. So we can look at this and see, do we find some resistance here at 61.8? I think it's likely, again, being overbought and hitting a strong fib level. It's difficult for me to imagine that any of these markets that I've shared with you so far are going to have any sort of a significant update tomorrow. So let's see if I'm right or wrong. Right there on the record. So we'll be able to watch and see. And this is recorded, so you'll see the recording as well. So looking at the Qs, a little bit of a bounce up towards the 50% corrective level, also nearing some resistance here at this 360 level. The wave 5 impulse pattern to the downside is still intact here. And so the wave 5 low is still in place. So even though we've had these bounces and they've looked pretty strong, you look at the volume here, bring it back down, and you can see once again the volume very similar to the SPY. Volume has dried up a bit as we've continued to move to the upside. So hitting this level on lower volume, difficult to imagine that we blow right through that level without some sort of backing and filling and letting the 10-day moving average catch up. The IWM, have we broken out of that trend channel yet? So the one at from 190 to 210, still the answer is no. So with the move in the SPY, the IWM hasn't come along for the ride. Otherwise, we would have broken out of that area, which is starting to show that, as hard as it might be to believe, this trading range between 190 and 210 may be just as strong as the one back there was between 210 and 230. Back there, I mean, last year, 2021, you know all this by now. We traded between 210 and 230 for the entire year, except for this little brief period where we broke out in November, but then came right back down. So the breakout didn't hold, right back into the trading range until we broke below it in January and set up this new trading range, which we've been in for 2022. Now we do have a bullish crosshair of the 10-30 moving averages. That lime green line is the 10-day moving average. The fuchsia line is the 30. A lot of floor traders, institutional market maker types watch that 10-30 for trend ideas. So are we going to break above it? We're not as overbought on the IWM. So you can see there's not the separation of the 10-day moving average that there is on the SPY and even on the diamonds. So setting that up, really there's a greater chance that the IWM breaks above 210 before the SPY or the Dow break to higher levels. We'll see how that plays out. Looking at Bitcoin, And we've been marveling at this triangle that's formed in Bitcoin. We actually did send out an alert to our subscribers on BITO. On Bitcoin is a way that you could put a strangle on Bitcoin. So you can see that that's about as well formed of a triangle as you're going to ask for. So something is going to happen with Bitcoin in the not too distant future. And if you take a look at the DMI there, it's finally come down enough to the point where it's interesting, which is why we did send out an alert on BITO for a strangle for our subscribers, our unique way of doing strangles, where we take advantage of what Ken's going to be teaching you tomorrow night, delta and gamma. We put those two maths in our favor to where if the stock breaks out, we are then guaranteed to make money as fast as mathematically possible. We're not guaranteed to make money. I want to be very clear on that. The stock has to break out, but if it breaks out and runs, the movement, the breakout, we've put the math between delta and gamma in our favor to where we'll make money as fast as possible if or on the breakout move. So beautiful timing on Ken's class tomorrow night in the Option Accelerator live class. So hopefully if you're not a subscriber, you'll take advantage of it tonight so that you can be involved in that, because it's ideal timing. And with the VIX coming back down, we're going to be seeing more strangles now. Not a big fan of putting on strangles with the VIX above 30, but once we get back down and we're below 25, now all of a sudden they're very viable. And if the market does, think about this scenario, if the market does consolidate the SPY, we'll go back to the SPY real quick. If we do consolidate this overbought scenario that we have, and it isn't a big move to the downside and just some backing and filling and consolidation through here, think of the number of triangles that'll be formed throughout that. And with the VIX being lower, strangles are a very real possibility. And you're not picking direction. You make money whether the stock moves in either direction. So I know there was a new subscriber in our new subscriber calls, and we have a welcoming new subscriber call where we're going to detail on how to utilize the website, etc., for people that join. And there was a comment that I know y'all do a lot of strangles. Those are tough. Well, in general terms, you could consider that you need a significant move, but I submit to you that we do them differently. We do them in a unique way. It's kind of my claim to fame in the world of options by taking advantage of the delta and gamma, the math that I mentioned. We don't do strangles as they're taught. If you look on Google, if you go to the internet and start looking up strangles, that's not the way we do them. We do them differently. And so in a normal scenario, straddles and strangles are both difficult in the fact that you need significant moves to make money, not the way we do them. So you just need a breakout of a triangle. So that makes them a little more attractive, I think. In fact, our average return is in the 30 to 70%. We have all the data to show that. We did one just recently on silver that was 106%. Now that's rare. Obviously, you like to highlight the really big ones, right? Those are always fun to talk about. But that was a little more of a return than normal. So I just thought it would be interesting to talk about if the market does do some backing and filling, what great timing that would be for strangles. So looking at the XJO, the Aussie market with this big, huge triangle, and you could certainly argue that if the rest of the markets follow Australia, we are not done moving to the upside. We go through a little backing and filling on the US market just to satisfy the overbought condition and get ready to run some more. The breakout has been significant to the upside on the ASX, and you can see that just straight to the upside. Perhaps it might need to rest just a little bit as well, because we are just a bit overbought from that scenario. But notice the different structure in the XJO than we had in the SPY. And this triangle is a big one, so it's not done yet as far as the breakout move. It's starting to get to the point where this doesn't look like it could be a head fake or a false breakout. That's always a possibility. Or you break out vertically and sometimes you come back and test the breakout and then you run. That would play into the scenario of the US markets doing some backing and filling as well. Perhaps the ASX comes back a little bit towards the point of the triangle and then takes off. Those things make sense. And I've mentioned before that the market doesn't always give you the ideal scenarios. In fact, often it doesn't, but it is kind of nice when the ideal scenarios do play out, and everything that's going on makes sense with the norms. When things get out of whack or discombobulated, as I say, that's a little more difficult to figure out and understand. So looking at the Nifty, I'd like to briefly cover all of the markets because we have viewers, especially on the internet, from all over the world. And you can see here that the 10-day is about to cross the 30-day on the Nifty, but we still have a 5-wave impulse pattern to the downside with roughly a 61.8, just below a 61.8% wave 4 there as well. So you can see that globally, we're at a point of potential resistance. The market that is standing out from that would be the ASX and the Canadian market, other than the fact that I'm concerned about that vertical breakout from an already overbought condition on the Canadian market. But I've already covered that in detail enough. And then the DAX, we cover that often in the SPY updates on YouTube. And I didn't cover it this past week because we try to rotate it around and talk about things that are interesting to everyone. But often we do talk about the DAX, and the DAX has just been, if any of you ever doubted how accurate Elliott wave is, all you'd have to do is go back and look at some of our previous recordings on the SPY on the DAX, because it has been just step by step by step, perfect Elliott wave. The patterns couldn't be more routine or the norm for Elliott wave, just absolutely spot on. And now we're at another wave B correction up near 50%. This 3, the wave 5 relabeled 3 times to a wave 3. And so here we sit, a little bit of consolidation right here at that 50% B wave correction, still showing a potential wave 5 lower. But the DAX has been, I mean, it's hit so many Elliott wave patterns on the way down that if it were to miss this one, I think we can forgive Elliott wave a little bit on this one, because man, you would have done extremely well trading Elliott wave on the DAX on the way down. But it's still an extremely well-formed impulse pattern, and there is the possibility that we come lower. Now, people have been asking, well, what could change the scenario of this bounce? Because it has been a pretty vertical bounce. What would change the scenario of a potential move to the upside? And I have 2 different scenarios. One is that just suck all the people in on buying the dip, that you get the rip your face off upward rally within a larger downtrend to suck everybody in. I've covered that scenario. But the other scenario on what could change things is the unknown. What happens if China invades Taiwan? There's more chatter about that now that we're past the Russia invading Ukraine. It's not a given that China doesn't do that. It's a possibility. Assign a percentage, 10%, 20%. I mean, it's probably a low percentage that China does it, but it's not 0. And how do you think the markets would react if all of a sudden, with everything that's going on between Russia and Ukraine, China were to invade Taiwan? My point is that when you have a pattern to the downside that is still qualified, you have to respect that there's other scenarios that could play out that move things down. So with all the global instability right now, in addition to our Federal Reserve being extremely hawkish, they were hawkish in the last meeting. I thought the market rallied from that. It initially sold off and then rallied back. And then Chairman Powell comes out and says, hey, they're not rolling out 50 basis points. So a lot of people are saying that it's likely that the Federal Reserve raises 50 basis points, not just in the next meeting, but in the next 2. And the market has shaken that off completely and moved to the upside. And we'll see how the market trades if the Federal Reserve does go 50 basis points on 2 consecutive meetings. I don't think the market makes a significant rally if those 2 things play out. Maybe the market doesn't think that that's going to happen. But I know the Federal Reserve right now, and they're telling us this, that's how I know it, is that they are going to bust, or they're going to do everything they can to bust this inflation that we're dealing with right now. And I still firmly believe they're going to overshoot the mark. Now, that could be well down the road, next year, following year, who knows? So that's that's getting too far away to really talk about. We want to try to keep things more on what's going on right now, but that covers the markets pretty well. And so, you know, if we have another big move to the upside tomorrow, then it'll surprise me, but I've been surprised before. And so anyway, that's what I wanted to share with you regarding the markets. As far as case studies, and this kind of plays into what we looked at just last week. And so last week, so I'm going to start and kind of combine these two. Let's take a look at Dollar General here. And this is what we looked at last week. Here's where we were last week. And I wrote in my notes that if we were to get a follow-through day the following day, because we had broken above resistance right here, that you could look to go long Dollar General. That's in my notes. That's what we talked about last week. And the next day, no follow-through day. We moved back to the downside. The following day was earnings, and Dollar General moved up big on earnings. Well, even though we didn't get a second consecutive day, which is what you're looking for, you're right before earnings. So we backed off a little bit to test that area. So we break resistance, we come back and test it, and their earnings report was okay. It wasn't anything fantastic. So Dollar General moves up significantly on just a fair earnings report. Now you have all that volatility sucked out from the earnings report, move to the upside. So the stock moves to the upside on just an okay earnings report. And then we sent out an alert, and that's this alert right here that you're seeing. There's the date, the 17th. We sent out the alert to go long, and we did a call debit spread on Dollar General, looking for it to continue to the upside. The ADX was, well, there's the chart. Dollar General breaking to the upside, and the DMI is showing us that we had strong confirmation on the move back to the upside here. And so it looked like, hey, we are going to continue to the upside. So with that, we sent the alert out, and lo and behold, the very next day, boom, we moved to the upside. I'm going to highlight this chart because you can see boom, boom, boom to the upside, and we're overbought after one day. So our subscribers like, well, why didn't we send it out after TradeFinder on Tuesday, and then we would have caught this move? You know, it's tough sometimes because we followed the rules. That's the reason. And the rules are we didn't get a follow-through day, and it's an earnings report. And so we let that play out. We were able to take advantage of that move and still generate a really nice gain. We got almost 31% in one day. But, you know, it's the nature of the beast, right? Oh, well, think of how much we could have made if we would have caught the previous day. Okay, you can money morning quarterback all you want, but we followed the rules. We still generated a nice 31% gain in one day. I'll take that every time. And we sent the note out that by a general rule, if we can make 30% in a day, we take it. So when we look at the chart, you look at that and say, well, look at those two moves. The stock is likely to continue higher. Why close it out? Because now we're really overbought. And so we're significantly overbought. We had the 30% in one day, which 99 out of 100 times we're going to take, because that's just one of my general rules. If you make 30% in a day, regardless of what the charts say, you go ahead and take that. Well, let's go back and see how we did. All right. So that was the day that we got. And that was when I said, all right, we're overbought now. And this is going to play right into the scenarios that I was just sharing with you with the Canadian market, the SPY, et cetera. When you get overbought, watch what's happened to Dollar General since. So over these last couple of days, we've come back towards that 10-day moving average. And so we got a nice little pop here on this second break, 31%, just under that in a day. And the exit was correct at this point. Now we can come back and look at this, you know, a week or two later, and perhaps we do consolidate this move, and then we go back here. But that gain would have been largely gone with these last 2 days. And who knows if we, with whatever happens in the market, if we just come back to the 10-day moving average and then take off, maybe we do. We're going to keep an eye on it because there's major resistance right here, which would have been the initial thought. on the trade of trading it up to resistance if we hadn't gotten the 30% in one day and become significantly overbought. So with all that stuff in mind, at least for now, we made the absolute right move to go ahead and close that position out and take that gain. So this is exactly what our website looks like. Every one of our alerts that's sent out has all this same information in it, what the trade is, the entry, the exit. I know there's a lot of alert services out there that only do exits, or excuse me, only do entries. They don't give you any adjustments or exits. We send out alerts from beginning to end. We hold your hand from the beginning of a position right to the end. You know, in TradeFinder here, we identify potential case studies, but then you're kind of on your own on how you handle it from there. So did you follow along with that one? Did you do anything with it? Did you follow what we said on the follow through day? Did you get in the next day? How did you handle this? Because we looked at this last week. Be interesting to see. All right, so going back and looking at a couple other things on the markets that I wanted to share with you. The TNX, you can see this vertical move in interest rates. And is that just because of the Federal Reserve's rhetoric, or is money coming out of the bond market moving into the equities market? I think it's both. I think it's a combination of the two. The Federal Reserve becoming even more hawkish than they were at their meeting when they announced the 25 basis point rate hike. And I was almost like, why didn't you just go 50 at the first meeting? And I think that was a saving face thing. Now they've prepared the market for it. And, you know, we'll see if the Federal Reserve can. Alan Greenspan used to really try to massage the market as far as what the Federal Reserve was going to do, but nobody could ever understand what he was saying. And there was the joke of Fed speak, and used to show this cartoon of Alan Greenspan with a whole bunch of gibberish coming out of his mouth, a bunch of financial terms that didn't really make any sense. And he liked it that way. The Federal Reserve today is far more transparent than Alan Greenspan's Federal Reserve was. But, you know, we can argue about being that transparent. They're flip-flopping all over the place too. So the market has a little more difficult time figuring out what they're going to do. But pretty vertical move. We're actually a little bit overbought on rates right now. And at what point do we start to get money coming back into the bond market to take advantage of that? I don't think the bond market has to go much further than that. The other scenario that we have that I think is worth talking about is the yield curve is flattening out. And with the yield curve flattening out, it's inverted in some denominations. You know, the overwhelming majority of the time signaled that you have a recession coming. I mean, oh, it's different this time. And I've talked about that before. When somebody says it's different this time, it's usually not different this time. It's a pretty good indicator that when the yield curve inverts, that you are going to have a recession at some point down the road. And I think the Federal Reserve overshooting the mark, they don't care. They even made the comment that they will sacrifice growth to stop inflation. That was in their commentary. That's not me summarizing what they said or speculating based on what they said. They actually said that they will sacrifice growth to stop inflation. Okay, well, that's nice. You created the inflation in the first place by having easy money for too long. And now you're going to hurt the economy to fix the problem you created. That's nice. No, anyway, don't get me started on the Federal Reserve. As I mentioned, one day we'll do a whole session on that, I think, just for people that aren't really fully in tune with how the Federal Reserve works and who they are. So I wanted to show that to you. And I also wanted to show you the dollar. This concerns me a little bit here. We're continuing to consolidate. Now, on one hand, we had a pretty nice vertical move in this wave 3 on the dollar. And to go through some consolidation after that move is fine. You can see that we have a symmetrical triangle here on the dollar and a doji today. So does that mean that the break comes tomorrow? Maybe. If we break to the upside, that's great. We have a new wave 5 target much higher, but it's down the road. It's into next summer as far as when the dollar could move to the upside there. If we break to the downside, that's okay too, because at some point we do have to label a wave 4. We've had a nice wave 3 run. And as I mentioned before, my concern would be if the dollar were to break out and break below 97. So if it breaks out of that triangle, it could still hold 97. But if we break below that and we break below that support, then I start to be concerned about global growth, global economies. Because if the dollar backs off like that and people don't want to put money into the dollar anymore, what's going on? And that would be concerning to me if that were to happen. So we're a long way from that happening. So just something that I'm speculating on with this triangle. We're going to break one direction or the other, and I can't tell you which direction. I'm a big believer that when you have a triangle, you respect the opportunity for it to break both directions. You don't just pick a direction. And again, a downside breakout is okay, in my opinion, as long as we hold 97. If we break below 97, I get worried. So those are my thoughts on the dollar. All right, going and look at some of the past case study considerations. Again, there's only a few of them left that would be considered to be still open if you were following along with them. And this goes back to February 8th, where we looked at Fifth Third Bank. And I'm still of the belief that the financials are a good place to be this year. I don't like the inverted yield curve. So when rates go to the upside, we've been talking about this, and now I'm getting the answer. I just mentioned to you that when things become discombobulated or they don't work as they're supposed to, then what's going on? It doesn't usually last that long. These things usually come back into line. And I've been confused as to why the financials haven't been doing better when you have interest rates doing that. With interest rates going up, why are the financials not performing better? Because the yield curve is flattening. And so if rates go up, but they don't get that spread, that's where the financials make money. So it takes more than just rates going up. Usually, if rates go up and the economy is okay, then the yield curve widens and it goes more vertical, and then that spread is how the financials can make money. So I have my answer now on why the financials haven't been performing better, because the spread's coming in, because the yield curve is narrowing and again is inverted, and they can't make money in that scenario regardless of how high interest rates go. So they need the spread because they borrow on the short end, lend on the long end, and if there's no spread there, they can't make any money. So that's given me the answer that I've been confused on. As far as, you know, you've heard me speculate on things that didn't make sense in the past, and then they fall in line and then things make sense. Okay, that's the answer. That's what's going on with the financials. So you look at this now, and we've had a pretty nice recovery, because if you go back and look at the entry, we're at 49.50, and now we're back up to 47. Call it 47.50. So been a nice recovery here with a wave 4 at the 61.8% level. And we do have this wave 5 target, but the yield curve is going to have to steepen again if that is going to go up and hit that wave 5 target, in my opinion. I guess it could do whatever it's going to do. But I think that making a new high and running up and hitting that wave 5 target, even though we have a pretty well formed impulse pattern, is going to take that yield curve steepening. So what does the narrowing, flattening of the yield curve mean? That's not forecasting good economic growth. And that probably came directly from the Federal Reserve saying they're willing to sacrifice growth. And so the market's pricing that in. The bond market is very smart. And you've heard me say this before as well, that if you want to be a good equities trader, it's good to have at least a working knowledge of the bond market. Because there's so much money in the bond market. There's more money in the bond market than there is in the equities market, and widely regarded really smart people in the bond market. So anyway, I thought I would give you a little extended talk there, because I'd been confused on financials for a little while here. So then we still had AGCO that was on February 15th. And look at that, patience. It came back down, it filled the gap, and then it's taken off to the upside. And we were at 133, and we hit a high of 140, almost 143. So pretty nice move there. Got a little bit overbought, so we couldn't hold the high of the day. If we look at the 10-day moving average, there's that overbought scenario and why we couldn't hold that high. But there you go. There's a nice run there. If you were patient and waited, then you were rewarded. And you can look at this and say, wow, we had a nice ascending triangle pattern that formed here. And then we got the breakout. Not the greatest follow through day when you close near the low of the day. It did close higher, closed up $1 on the day. So it still counts as a follow through day. Would have liked to have seen it hold maybe around 140 or something, just a little bit higher than closing on the low of the day, but it was overbought on the breakout. So you might be being a little greedy with what I've talked about regarding the market needing to back and fill a little bit if you had stayed long here. So we're going to go ahead and cross this one off, because that would have been a profitable position if you followed it. So nice gain there. So we won't look at that one anymore. And then Vivo, Meridian Bioscience. Now, when you take a look at this, we talked about the triangle forming. Look at that. It's even better now. Just really nice symmetrical triangle. And the temptation would be to really morph this into a strangle, because it's just such a really nice symmetrical triangle pattern. However, when you look at the DMI, the ADX is still above 25. What does that mean? Well, it means that one of these scenarios could play out, one of these extended sideways things. It's a pretty well-formed triangle. And when you have triangles, they break out an extremely high percentage of the time. When you have a well-formed triangle, whether it's ascending, symmetrical, or descending, they break out an extremely high percentage of the time. So I would submit to you that it's likely that this breaks out. But the ADX being above 25, we would not send that out as a strangle to our subscribers due to the fact that the ADX is too high. I like the ADX being lower, indicating that you're closer to a breakout than further away. That's just kind of one of our rules. And so we already covered DG from last week, but we also looked at silver on the potential of maybe putting on another strangle on silver. We already had the one, and look, it's forming well again, and the ADX is still low. So I think you could look at, we had that nice one, as I mentioned, where we already had one breakout and generated over 100%. I think you could look at silver again for another strangle, and that's going to be pretty difficult to avoid. In fact, I'm just going to go ahead and call that as our case study consideration, because running a little long, I thought I would do a better job of getting through the markets, but I felt like with everything going on, some additional commentary was needed with where the current market is. But for this week, that's going to be our case study. So for 322, it's going to be that SIL strangle with the low VIX, and we'll see if we can do anywhere near as well as we did on the last one that we sent out. So our subscribers can probably expect to see a strangle come out on that tomorrow. It's not the largest triangle, but it's large enough. So what we want is, when we look at the mouth of the wedge from the low to the high, we want that potential spread to be 10% of where the stock is. So from 34 above 39 is over 5 points, and we're at 36. So we have our 10% there. So we're going to go ahead and put that in as our case study consideration for this week. A strangle on silver. People always ask about it. I imagine there's already questions on the metal, so we've already covered that. I'll just go ahead and look at gold real quick, and then I'll open it up. We'll bring Zach back on, and we'll take a few questions here as we move into wrap things up for this week. And as I mentioned, it's kind of same scenarios last week. What goes vertically up often comes vertically back down. It's exactly what happened with gold. You could look at this as a bit of a triangle here as well on gold. Taking a look at that, kind of like the one on silver better, just because this is such a vertical move here, but often in the mouth of a triangle, you do have a fairly vertical move if it's in the A wave, etc., of an Elliott wave triangle. So not too bad looking here. You look at the DMI though, and the ADX is way too high. So even though I don't like the structure of that triangle as much, I'd have a difficult time arguing with you that, hey, that is a triangle on gold, but look where the ADX is. So gold could go, it's hard to imagine silver breaks out and gold doesn't move, but silver is the better looking of the two charts, in my opinion, based on the rules that we follow at Elliott Wave Options. So with that, I'm going to go ahead and bring Zach back and see if there's a few questions that we can cover here over the last few minutes. So Zach, you there?
I am. Yes. Hi, Rob. There are tons of great questions from both Zoom and YouTube that have come in. So I'd like to mention again that if we don't get to your question tonight, please feel encouraged to ask it again on Thursday as we focus much more on the questions at the other half of the session. So with that being said, we'll start out with this one from Nicholas on Zoom. Hi, Rob. I'm looking at what's probably a confirmed zigzag to the upside in BVN. Was wondering if you could take a look. I see the A wave starting January 24th with a 61.8% B wave retracement. Looks like today was the confirmation day to center. I was mainly wondering if you see divergence on the CCI. That's the only thing I can find to not like about this setup, but I'm not sure if I'm correctly applying the concept of CCI divergence.
Yeah. The CCI is supportive of this. That's not the greatest follow through day though, but I see the pattern that you're looking at. And since we're talking about energy, I'll go ahead and bring this up because I wanted to look at USO. So yeah, I do like that for a strangle. And taking a look, you were talking about a zigzag though, right? Zigzag to the upside. Was that the question, Zach? Was it a zigzag or a strangle?
Correct. It was a zigzag.
Okay.
Firm zigzag to the upside.
Okay, right at the 61.8% level, and then we're at 61.0. So we have some resistance right here, right at 61.8. That is confirming on the. So there's not really divergence here on the CCI. It's confirmation, which is what you want. Let's look at the 10-day moving average. And so, you've got both though, right? So you have, not only do you have a qualified zigzag, Nicholas, which, so you're right, but we also have, and this is what I was looking at, is this ascending triangle here. So we're at resistance and we have the pattern of higher lows. So, we've got a complex zigzag pattern because you have a pattern within a pattern, and we're right at the 61.8% level, tiny bit overbought. So that shows you why we didn't break above it in today's trade. So I think there's a great chance this breaks out of the triangle and runs and hits that 100% extensions. I also like energy. I've been talking about energy. And I mentioned that after this vertical move in oil and the move back to the downside, that I thought, okay, oil's not done going up. You probably heard me say this in last week's TradeFinder. Oil's not done going up, but I expected the move to be a little more like this, a little more of the 45-degree angle that I like. And lo and behold, it moved vertically to the upside again. Surprised me a little bit. Maybe we just consolidate here. We've got a doji today. So I don't know if maybe oil needs another consolidation day, and then we slow down that vertical move and start to go more in a 45-degree angle. That's what I thought out of oil. I was really surprised to see that big move back to the upside. So we'll see how it plays out, but I do like energy higher. I don't think oil's done going to the upside. I like that space.
All righty, thanks for that, Rob. At this point, we'll transition over to the YouTube questions. And this one from Douglas is, why would Russell be in wave 1 and SPY and triple Qs be in wave 5? What does that tell us?
Well, it tells us that money is not moving into small caps. So that's a sign that people are looking for a little bit less risk. So they're favoring the blue chips more than they are the small caps. Now, if the small caps break out of this 210 and this relabels and moves into a wave 3 to the upside, then we might change that scenario, or we'll see if we get an impulse pattern labeled on the SPY. I think those two scenarios are both in doubt. But right now, since the question was asked right now, since this is still technically in the trading range, it's telling us that money is favoring a little more quality, a little more of the blue chips than the small caps. But hey, by the time we get together again next week, that could change. So hopefully you'll come back and watch again next week and ask the exact same question, because there may be a totally different answer. But for now, that's why.
Absolutely. And moving back over to Zoom, Susan asked, VIX is low, time to go. Is under 25 low now, or does VIX need to drop lower? Does normal mean what one thinks it means? Joking, Princess Bride. So some triangles don't retrace. Are we in an episode of the Twilight Zone?
I think we were in the Twilight Zone when the VIX was above 30 for 16 days in a row. That was something surprising to me. I actually did think the VIX would have a little more support at 25. So I'm right with you there. And, it hasn't broken significantly below here. Again, we'll see what happens over the next day or two. If the market pulls back, perhaps the VIX does move back above 25. I was kind of surprised to see yesterday and today. I thought we might start the week with a little more backing and filling, a little more volatility, but the market is just powered higher to start the week as well. And, it's going to do that until, if the downside scenario plays out, until the shorts have totally backed away. They're just if you watch the intraday chart, they're not even attempting. There's very few selling attempts throughout the day, and the ones that occur are minor. And so the sellers have just stepped back. They're letting the buyers have their way. Are they setting them up? We'll see. And but as far as the real hard support is down here at 15. There's more support at 20, but there was support at 25. So I see exactly what you're seeing. Susan, I think, was the person that asked the question. And are we I think we're in the twilight zone with the Federal Reserve. We should not be in this mess. We shouldn't. We should have come out of the pandemic scenario, and now we're starting to see that there's a new variant, and that's spreading around China and the UK, et cetera. So are we going to see Omicron come back again, as far, not Omicron itself, but the scenario of a whole bunch of infections coming around again because of the new variant? That's another one of those black swans that could derail things if that gets significant. I don't think it's, usually when you have these viruses, they mutate, and I'm not a medical expert. All I'm doing is reiterating what I've been reading. So please, I am not pretending to be a medical expert in any way, but from what I've read, it's normal for viruses when they come out, when they go through the mutations can be more contagious, but they usually have less severe symptoms. And that's how it usually runs through its course. They don't disappear forever, but the symptoms become less severe. Is that going to happen with this new variant? I don't know. We don't hear much about that because we have Russia and Ukraine and the Federal Reserve and everything else going on. So there's so many other news things. We're not hearing as much about this new variant as we did Omicron. So I'm with you on this potential support at 25. I've already surprised this week. But it didn't move a huge amount, right? For the amount of rally that we had yesterday and today, it kind of could have thought that we would have been down to 20 already, and we didn't. So is that precursoring and telling us that maybe we bounce back up? We'll see. I wish I had a full-scale answer to your question, but I'm looking at exactly what you are.
All righty, thanks, Rob. And moving back to Zoom, Jim asks, wouldn't a close above the 200 DMA again tomorrow or for the second consecutive day be significant on the SPY as trend confirmation?
Yes, it absolutely would. Yeah, I mean, because if you look at the 200-day moving average, there we are. So we broke above it today. Could we break above it again tomorrow? Because we have another we could. I mean, you can stay overbought and oversold for periods of time, but not long periods of time. So the fact that we've moved this vertically, yesterday's doji didn't do a thing today, just powered right through that 200-day moving average. So we had a doji on top of the 50-day, below the 200-day, and it meant nothing. And that just shows you the shorts they're nowhere to be found right now. They didn't even try to push this down today. There wasn't even an attempt to sell it. So now we're there, but remember, we have this resistance here at 452. We're overbought. But you'd be right, if we do give another confirmation day and we break above resistance, that would be tough to not say that, hey, we're in an impulse move back to the upside now. And we can look at all the fundamental reasons why that makes no sense, but the market often makes no sense. If you try to trade the markets based on what makes sense, you'll be beating your head against the wall a lot.
All right, and so we still have tons of great questions coming in from both Zoom and YouTube. I know we are past time, so I'm happy to stay on and pass through as many as you like. You just tell me when we're done.
Yeah, we really try to keep this to an hour, but since I ran most of the time, let's do a couple more.
Sounds
people
great.
Have been patiently waiting. We'll grab a couple more.
All right, so Mike from Zoom asks, any thoughts on Barclays' announcement to discontinue issuing BXX support in terms of issuing shares? I just think that trading volatility right now is really hard. I'm guessing that they've had some clients lose a lot of money doing that.
that's speculation. I haven't read a whole lot about that. So all I'm doing is speculating based on very little information. So I'll take a look at that, and maybe you can ask the question again next week, and I'll try to give you a more detailed answer.
Thanks for that, Rob. And this is a good one from YouTube that I'm sure will get you going on the Fed talk. Lucky's Craft asked, Fed might have been 6 months too late, but let's see if inflation rate cools off in second half of 2022, we'll be looking better, or this summer.
Well, I think that's a scenario that could play out. I think that's an excellent point. Remember, the Federal Reserve told us inflation was transitory for so long, and then admitted that it's not. And so they had to eat their words there. And they are going to overshoot. I feel so confident in this. They're going to overshoot. So even if inflation starts to come in a bit, I don't think they're going to back off. I think they're going to go too far. They're going to raise rates too far, even if inflation does come in, which I think your scenario is possible, is very possible that that's what happens. And that just adds to the Federal Reserve they are really scared about this inflation thing. You don't want to let inflation get away. And so they're not going to. And I just firmly believe that they're going to overshoot the mark. And it'd almost be worse if inflation came in, as bad as that sounds, because then that means their hawkishness is going to cause further damage to economic growth, if that makes any sense. So it'd almost be better for inflation to stay elevated so that their rates are attacking inflation and not hurting the economy as much. So if inflation comes back down and they continue on the same path that they're now talking about, which is more accelerated rate hikes, that will cause further damage to the economy down the road and make the recession deeper. So yeah, I think your scenario is valid, and I just hope it doesn't play out that way. I don't think, I mean, I know your question was, could the Federal Reserve back off? I don't think they will. That's my opinion. I don't think they will. If inflation comes in, would they become a little bit more dovish? Maybe at some point down the road, but not in the near term. I just don't think they will. As I said, I've been wrong before, so I could be wrong, but I don't think they will. History is on my side.
Well, we will surely find out. So John from Zoom asked why you were looking at SIL instead of SLV.
They have no real reason. They're both silver, so just what I typed in. No big reason why. So same pattern. Yeah, I did no real reason. Just looking at silver. So
sounds good. No worries. So MD asked, can you please look into MU? Does it have more room to the upside?
Micron. Well, it hasn't moved the way the market has it? Now, remember, I've been stating this, and the reason for this is with the Federal Reserve becoming more hawkish, it's going to be even harder for tech stocks. And that's why I think the Qs are going to underperform the rest of the markets this year. It's just going to be very difficult. Could it go further? Does it have more room? It's nowhere near as overbought. It hasn't even gotten back to its 50-day moving average yet. It is trading right through the 200-day, but it hasn't made it back to its 50-day moving average yet. Is there room to the upside? There is. Is there significant room? I don't think so. The DMI is not suggestive that there is, but I think it's more the Federal Reserve that's going to hold it down, because it's going to be difficult for tech to do well in the environment that the Federal Reserve is telling us they're going to be going through and doing. So yeah, it's underperformed, and that's probably why you're interested in it, because could it catch up? If it does, I think it'll be short-lived. So if you were to get a bounce, some sort of a pop above 80 there, the most compelling reason to be long this is the fact that it's consolidating under a resistance point. And so that's the scenario that I've been mentioning would have been better for Canada, et cetera, the markets to consolidate and then bounce, because you have a better chance to run. But 85 is going to run into more resistance, so it's going to bump its head. So I don't know how far it can go. Does it have more upside? Yes. I don't know how much. I don't think a lot. Let's do one more, and then we'll wrap it up.
All righty. Sounds great. This last one will be from Manuel on YouTube, PANW.
Oh, that's a Palo Alto is a good one to ask about. With what's going on with the threats of Russia and cyber attacks, et cetera. They're going to do whatever they can to get back at us. They're not happy with us, sending supplies to the Ukraine, et cetera. And, there always was the talk about cyber attacks from Russia before all of this started. And that's why you see this big break here. So that's a really nice break of resistance that occurred today. It is overbought though. So let's see what happens as far as a potential follow through on that tomorrow. It's a bit overbought, so it might need to back and fill, but I think this is a good place to be. I think you picked a good one there. As far as if you want to be long something, that's a pretty good place to be. We've got a pretty decent wave 3 underway here. We're breaking out of a triangle. Lots to like on this chart. The only thing that would concern me is if it broke back below 560. So that would be your stop to the downside as long as it holds and stays above that. It could even give up this 580 that it's found, a little bit of break above here and come back down to 560 and still be okay, I think. But a break of 560 would change my opinion. Other than that, I think that's a good upside one. Thanks, everybody. Thanks for your attention. Thanks for everybody that was live streaming with us on the social media outlets. This world is crazy as far as the way technology works, and we can communicate to more people. And I sign off the same way every time. Time is the most valuable asset we all have. That's my belief. Pretty passionate about that. And we very much appreciate when you devote some of your valuable time to us, and we in turn try to make that an informative and educational use of your time. Thanks, everybody. What a great time to become a subscriber. You heard what Ken's going to be talking about, everything it plays right into the strangles that'll be coming up, et cetera. So if you've been viewing for a while and haven't subscribed yet, no better time than now. So thanks, everybody. Talk to you again next week.